Global Equities is going to take away the afternoon for us. So would Will and the panel like to come up and give us a flavour of what's going on in global equity markets?
Thank you, Francie, and thank you, IMAP, for having us today. For the last session today, we've got global equities. On the panel, I'm joined by James Harwood, Hugh MacNally and Tim Richardson from Russell Investments, PPM, and my fellow colleague at Pengana. Before we jump into the panel discussion today, I'll hand over to Tim to just run through some points on why global equities and why now.
Thanks very much, Will, and thank you everybody else for being here for the last session. When we were told that we were up on the 1:15 shift, I thought it would be the four of us and maybe Toby, so thanks a lot for hanging around. But what we did want to do is spend a little bit of time looking at what are the things that investors should be thinking about in terms of their global allocation at the present time, particularly in light of interest rates starting to come down at a time when valuations are, still pretty pricey, despite the volatility that we've seen in the markets of late. This is obviously a panel session, but I wanted to sort of kick off with some of the thoughts that we have here at Pengana with regard to what we're seeing in the global equity landscape. Now I'm going to try make this work. No, before we do that, we'll talk about why global equities. Traditionally, in Australia, investors have had a decent allocation to Australian equities. Now, we in Australia, we've got some really good miners, banks, energy companies and real estate groups. But Australia is less than 2% of the global share market. And by adopting an exposure to global equities, that gives investors opportunities to access more opportunities in technology, industrials and pharmaceuticals, for examples, and across a much wider range of economic environments. It does work. But global equities, why now? Is this a good time for global equities? I'd like to just touch on three big things that are happening in the global equity environment at the moment. Firstly, interest rates. They've been coming down across the major developed economies. It's no secret that the US is likely to follow later this week. We're seeing a wave of innovation, particularly in AI. That's what the media gets very excited about, but it's a lot more than AI. Over a period of time, we're likely to see that drives productivity growth, which we've not seen a lot of in the global economy. And we've seen, we've heard a lot about consumer spending falling off the cliff. That's simply not happened. Sure, there's a lot of sections of society that are doing it tough at the moment. We're certainly not in a retail boom by any means. But the fact is people are still spending, particularly spending on services. Now, these three factors together, they suggest that earnings growth is going to continue, and that's going to give some sort of support to global equity prices. So where are the opportunities that we're seeing at the moment? We think investors should be looking at companies with innovative business models that are able to grow their earnings through the consumer spending cycle. Costco is one example of that. By keeping their margins really, really low, Costco's been able to grow revenue by becoming attractive to a wider, more affluent demographic. That recognises the appeal of value and convenience, and this is a demographic that's willing to pay a significant membership fee each year, which in turn has the effect of driving repeat business. The AI revolution is transforming the global economy. That's not exactly news, but what we think is going to happen is the the value across the AI value chain is going to spread across, and particularly those software businesses that are developing the applications that are going to grow labour productivity are likely to see earnings growth, which is perhaps not, we're seeing the first signs of it, but it's not being reflected in share prices at this stage. One of the earlier speakers touched on the issue of smaller companies. Smaller companies are historically very, very attractively priced. As interest rates come down, if we have a soft or a softish landing, they'll have a great opportunity to outperform. But investors need to be a little bit careful. There are risks out there, and markets aren't cheap. Interest rates are coming down, that's not news. But the path of interest rates is unknowable and probably much more interesting than whether we have 25 or 50 basis points cuts from the Fed later this week. It's where the neutral rate comes to settle. That's going to be much more important to the earnings growth of companies. What does that mean to investors? Well, they should be thinking about balance sheets. You want to be looking at companies that are able to refinance their debt, raise finance to invest in new projects, regardless of where we are in the credit cycle, at attractive rates. Just because we're having a soft landing doesn't mean the economy is not slowing. That has big implications for the cyclical businesses, particularly those that are sensitive to consumer spending. That perhaps implies that long-term global equity investors should be thinking about those big long-term secular growth trends, AI, which everybody keeps talking about, the ageing population, the onshoring of industrial capacity, the electrification. And the other big risk out there is geopolitics. The US election, obviously, but also the long-running issues with China and trade, and also the Middle East problems and Russia. So where does that leave global equity investors? Could well be a bumpy landing. Global equity investors have got to be prepared for a bit of volatility. That shouldn't be so much of a problem for investors that are taking a long-term view and are properly advised. Growth is becoming scarcer and much more concentrated. Values not being spread at all evenly over the market or the economy. That presents an opportunity for active management. And here at Pengana, with our Axiom International Equity Fund, we're very much focused on analysing forward data points and insights across companies, markets and industries, rather than looking more exclusively at backward-looking financial metrics. What that means is that it makes it easier to identify in advance those big quantum shifts in total addressable markets and the inflection points in earnings trajectories, which are the things that really build long-term shareholder value. Thanks, Will.
Right, thank you, Tim. Great. So we've just had Tim talk to us about some of the factors that Pengana managers focus on. Now, Russell Investments and PPM both offer two different approaches to building global equity portfolios. Do you want to describe those, and are there a particular stock or sector that you find promising at the moment?
Yeah, look, so Russell's approach to equity investing is a multi-manager style approach, as opposed to guys on the left that are very much on the stock picking side. Our approach is to blend equity factors, whether that's growth, value, or sometimes we have managers we like that are more style neutral, but it's very much about trying to find that best of breed manager. So Russell has global scale. We've got a big team of research analysts in London and in the US, and they are out researching the best global equity managers from around the world. So that's kind of what we offer the Australian market. That a lot of the research to find those managers has been done by our team and blended together by the portfolio managers like myself. So to answer your question in terms of sectors and which sectors do we like, We don't take lots of views. On the multi-asset side, we have started to take some views on the sector level, and often that's down to addressing some risks in underlying equity funds. So you find that a lot of equity managers don't own a lot of REITs. REITs have been an awful investment because of the US office market. That's been in a really downward trend. But one thing we did want to do was address some of the risk there, and REITs are actually they're up about 11% over the index so far quarter to date, and I think it's worth saying as well that we've started to see the cycle turn. So the Mag 7 has that outperformance has ceased so far this quarter, and we're starting to see small cap and equally weighted indexes starting to outperform those market cap indexes. So we tend to look at what are the opportunities that are not addressed in our portfolios, and REITs would be one example, and small cap is another one that we've started to play as well. So we think there's some relative value with small cap, and REITs is a bit of an unloved sector that we're starting to see earnings forecasts grow for next year, and we do think that the market's starting to tell you that trend is close to bottoming out as well.
Thank you, James. And Hugh?
Thanks, Will. I suppose PPM's basic philosophy is that in the long term, the investor gets the return that the companies that they invest in earn. So in putting together a global portfolio, what we're really looking for are stocks with high returns on capital. With the caveat that the returns on capital are not static. Very high returns tend to revert to means. So the best approach is, it's not the best approach to pay very high prices for very high returns. We're really looking for companies with high returns that may not be maintainable, but they will retain enough to deliver us an excess return. So that the approach is really a matrix of the rate of return and the price we're paying for that rate of return we're paying on capital, and we use operational data over long periods of time, and particularly over the tenure of a CEO, to try and gauge how the company is deploying its capital and how that's going to affect the return on that capital. We break the return on capital down into its various components to have a look at how those are being driven. We don't use economic and other forecasts. We think that those are either too broad brush or too unreliable, or both. Really what we're putting guardrails around our decision making. We recognise that sort of unfettered human judgment is pretty unreliable. To answer the second part of the question, we don't really focus too much on sectors, indeed on country exposure or currencies. The screening is really for stocks that fit into the matrix that we have. But where we see candidates that are attractive at the moment is in the industrial services sector in the US. An example is United Rentals, which is the largest equipment hire company in the US. They've got a long history of high returns on capital. They've been able to invest a high proportion of their operating cash flow at high rates of return. About 50% of that is organic and about 30% bolt-on acquisitions. The returns that the acquisitions have produce for them means that the price that they've paid for the bolt-on acquisitions means that the return on capital has been maintained over a long period of time. They tend to make around about 2 acquisitions a year over the last 7 or 8 years, and there's probably 100 or so add-ons in a very fragmented market that they can address. This company is not expensive in terms of the price you're paying against the invested capital, and it fits very neatly into our matrix. And we think that there are quite a number of companies in this sort of area, and indeed in a lot of industrial areas that are still very attractive despite the rises in the last 2 years.
Thank you, Hugh. So in the last 15 years, we've seen the US market grow from 40% to now 60% of the world stock market capitalisation. And I know you touched on it before, James. The Magnificent Seven now accounts for almost 20% of the MSCI World Index. How does this US dominance affect your thinking, and how do you think the Magnificent Seven will evolve in the coming years? I guess all three for you to answer that one.
Yeah, look, it's a question you can't avoid with global equities. You know, the Mag 7 has driven returns, as we all know, and often active managers are underweight those stocks. They look for better opportunities outside, highly valued mega cap stocks in the market. So, we've suffered from some performance there by being underweight some of those stocks. But in terms of, I mentioned in my previous answer, firstly, we look to hedge some of the risks. So you often find global equity managers, particularly in the relative value space, will be underweight the US, overweight Europe. We look to manage some of those exposures through using futures. So long S&P 500 futures is the obvious way to address some of those risks from being underweight the US and the Mag 7. I think that's a really important risk to manage within the portfolio. So yeah, look, I think to answer your other questions around where are they going, I did speak before that we're starting to see the cycle turn a little bit. There's been going into US earnings season, there was a lot of press around the Nvidia earnings, and clearly the stock fell quite a bit after reporting its earnings. As I mentioned, we've started to see this quarter the small cap has outperformed. Equally weighted indexes have outperformed. I think the equally weighted S&P 500 index is 6.5% ahead of the market cap index so far this quarter. So I think that there's definitely signs, and similarly, Russell 2000, the small cap index, we're starting to see that as well. So, that's starting to outperform as well. So I think that's up about 4% relative to the S&P 500. So there are certainly signs of encouragement for fundamental stock pickers. It's not necessarily just going to be all about the Mag 7 going forward. I think they're fantastic companies. They have great earnings, so they're not crazily expensive like Y2K back in 2000, where tech stocks were crazily valued. I don't think we're at that point now, but so clearly the Mag 7 are going to play a role, but we do think that we're more likely to see a broadening of the equity rally or broadening of stocks, and I think that market leadership is definitely good for active management.
Thank you, Hugh.
We would divide the Mag 7 into 2 groups. The first being Microsoft, Amazon, Meta, and Google. These we think are expensive, but not outrageously expensive. At 10 to 15% cheaper would be within our matrix. The other group, Nvidia, Tesla, and Apple, are well outside our matrix, and 2 of them are supported by capital returns on capitals that are so high that we think that they're highly unlikely to be maintained in the long term. So we think there's a fair bit of downside in Nvidia and Apple. Tesla, we think it's just far too expensive for what is really a reasonably modest return on capital. And look at the decline in their margins as an indication that even that return is perhaps not maintainable. So the Magnificent Seven, the returns, the underlying returns that we assess are not nearly as high as they are in quite a number of other sectors, particularly in the US market, and to lesser degrees in other developed markets. So I guess our view would be that as a result, that the proportion of the indices that the Magnificent Seven now occupy is probably going to go down over the long term. As far as the US position is concerned, we're finding that the rates of return on capital in the US is substantially higher than in most other markets, and while 60% of the total weighting in the index is very high, we think that the economics of US corporations is superior to that of other developed markets.
Brilliant. And Tim, anything to add there?
Yeah, just like to add a bit to the first part of the question. And then it's worth stating that this big shift towards the US concentration that we've seen over recent years is very much a sectoral shift as the global economy and hence the global share market has moved quite aggressively towards a technology focus. Listed companies in the information technology and the communication services are disproportionately located in the United States. So it's perhaps not surprising in this environment that we've seen that big shift that's moved over. But having said that, it's likely that we'll see the US adopt AI much more rapidly and effectively than perhaps a lot of the other regions, which will grow the US labour productivity growth more than other regions. That will be reflected in GDP growth. There's a tenuous link between that and shareholder returns, but it's not going to do them any harm. So that's perhaps a long-winded way of saying this is a state of affairs that we think is likely to endure. With the Mag 7, I'd echo the words of my colleagues here. They're quality businesses. They're delivering profits. They're throwing off cash. Are they excessively expensive or not? That's another issue. It's certainly imprudent to make short-term bets on those stocks. But they're big businesses that'll have a big impact on the growth of technology and AI. They'll be here for a long time.
Great, thank you, Tim. And just pivoting away from the US, considering recent geopolitical developments and economic indicators, how do you assess the investment opportunities in China, given the lack of consumer confidence, the lag in growth, and the potential risks of tariffs in US and Europe? Is China still investable?
Yeah, look, China is a long story in a way. There's a lot going on there. I think the lack of political reform has been, and economic reform has been disappointing, and I think that's one of the reasons the stock market has struggled as much as it has done. We still find, to answer your question, is it investable? We think it is. We think a lot is reflected in the price. So the Chinese stocks are very, very cheap relative to other emerging markets. Earnings are actually not so bad. We've started to see some of the big Chinese tech names do buybacks. So there is some kind of green shoots of reasons why you should not dismiss China. I know there's been a trend in emerging markets to go ex-China, which it is obviously people fearing that China is not investable. But we're actually seeing, in terms of which managers are playing that market, it's definitely the value type managers that like China. There's certainly reasons to be optimistic, but I think that we do need to see some kind of catalyst. And one potential catalyst could be there's a lot of social unrest, and I think that is the kind of thing that could give rise to a policy response from the government. But for sure, China needs to move away from, to address your geopolitical comments, away from this exporting economy to become one of more self-sufficient from a consumption perspective. So we think it's likely to do that eventually. The timing is always hard to call, but just to have no China exposure is a bit of a risk. If you do get one kind of positive policy response, you could see a lot of short covering and that market start to outperform.
Brilliant. Thank you, James. Tim, Hugh, anything to add to that one?
We don't invest in emerging markets.
That'd be it. Tim?
China's got some massive headwinds in terms of its demographics, the diversification of supply chains away from China, and also the real estate market, which people have sunk their life savings in. None of those are going to be resolved, within anybody's time horizon. That's not to say there aren't some pretty high quality companies in China, and the size of the market is something that makes it hard to ignore. But I think it's important to look at a stock level rather than the macro level when looking to invest in China. I think the first thing is that investors should be very clear that the company that they're investing is doing things that align with the priorities of the government in Beijing. So if you're doing things like AI, EVs, cybersecurity, clean energy, you should be good. If the company's doing things that don't align with the government's priorities, that's a political risk which is very, very hard to price. So you've got to be careful. And the other thing that's perhaps worth mentioning is that you've got to be careful about investing in companies that depend on exports to the US, the import of sensitive components from the broader Western world, and companies that depend on finance from the US markets.
Brilliant. Thank you, Tim. And I'll just sneak one more question in before we open up to the floor. Just to conclude, how should the global equities segment of a multi-asset portfolio be positioned?
I'll try and be quick. There's a lot of things priced in the market already. So, the Fed, I think there's 5 rate cuts or over 125 basis points of cuts priced by year end, which seems pretty optimistic. So, whilst you would think that having rate cuts is good for growth stocks, a lot of that is priced in from interest rate curves. So I would just really encourage investors to have a diversified approach to the equity styles that you invest in. So like a multi-manager type approach, should help you through the cycle.
Brilliant. Thank you. Anything to add, Tim and Hugh?
I guess our approach doesn't change much from period to period. We really just focus on a return on capital that companies generate and the price we can get that capital for.
Thank you.
Yeah, I think investors shouldn't get too bogged down with the minutiae of the sectors and the regions. The important thing is to identify companies that have got an enduring competitive advantage and are able to grow earnings sustainably over the long term. That means strong balance sheets. Look for innovative business models, alignment to the long-term secular growth trends, and smaller companies are cheap and they look interesting now.
Brilliant. I'll open up to the floor for any questions.
Questions from the floor? I didn't hear Tim or James saying this is a time to be overweight global equities in a multi-asset portfolio. Would that be your view, that, like neutral weights?
Look, it would be. I think being neutral is probably the place to be. Could we be at 6,000 in the S&P 500 by year? And definitely, yes, we could. But yeah, it's a punchy call to take a really big overweight to equities now, I would say.
Okay, Tim, thanks very much.
Brilliant. Well, if there aren't any more questions, I'll wrap it up there. Thank you, gentlemen, for your wonderful insights. And thank you again, IMAP, for putting on a great day.